What's up, everybody? It's Leela here, and today we're diving into how to actually grow a small trading account. If you're starting with just a few hundred or $1,000, it can feel impossible to make progress, especially when you see gurus flashing huge profits. But, with the right approach, you can start building your account today. I'll break down the top 3 beginner-friendly trading strategies that focus on consistent growth and risk management. No get-rich-quick schemes, just real, proven methods. Let's jump into the first strategy. First up is breakout trading, a simple, yet incredibly powerful strategy that's especially effective for traders with small accounts. It's a method that doesn't require complex indicators or years of experience, making it accessible for beginners and seasoned traders alike. A breakout occurs when a stock's price pushes above a well-defined resistance level or drops below a strong support level. This move often signals the start of a new trend and can lead to strong momentum as more traders jump in, fueling the price movement even further. Here's how it works. First, wait for a stock to trade in a tight sideways range. This period of consolidation builds up pressure, like a spring being compressed. Then, watch closely for a decisive move above resistance, ideally accompanied by a noticeable spike in trading volume. That's your entry signal. Go long if the price breaks above resistance, or go short if it breaks below support. The key is to act quickly and decisively when the breakout happens. Volume is absolutely crucial. Without a surge in volume, breakouts are more likely to fail or turn into false signals. High volume confirms that other traders are participating in the move, increasing the odds of success. Always protect your capital by setting a stop loss just below the breakout level. This way, if the breakout turns out to be a fake out, your losses are kept small and manageable. For example, if XYZ stock breaks above $12 with a strong volume surge, that's your cue to buy in. Place your stop just below $12 to limit your risk and lock in your trading discipline. If the breakout is genuine, you'll ride the momentum for a quick profit as the price surges higher. If not, your stop loss ensures your loss is minimal, allowing you to move on to the next opportunity without major setbacks. The process is straightforward. Identify the trading range, wait patiently for a breakout with strong volume confirmation, enter the trade, and immediately set your stop loss to manage risk. This repeatable method helps you catch quick wins, avoid big losses, and build confidence in your trading approach over time. Breakout trading is perfect for small accounts because it's clear, disciplined, and easily scalable as your account grows. It teaches you to follow rules and stick to a proven plan. Now that you understand the power of breakouts, let's move on to the next strategy and continue building your trading toolkit. Next up is swing trading, a style that's all about catching the market's natural waves. This method is ideal if you can't watch the market all day, or if you have a busy schedule and want trading to fit around your life, not the other way around. Swing traders typically hold positions for several days, or even a few weeks, aiming to profit from short-term price moves that happen within a larger trend. It's about finding those sweet spots where the market is likely to move in your favor. The process is simple. Spot a stock in a clear uptrend, wait patiently for a pullback to a support level or a trend line, and then buy the dip when the price shows signs of bouncing. You'll want to set your target at the next swing high, and place your stop loss just below the most recent low to protect your capital if things don't go as planned. For example, if ABC stock pulls back to its trend line at $50.50, you could buy there, set a stop at $48.90 to limit your risk, and aim to sell near $60 for a solid profit. This approach lets you capture bigger price moves without needing to constantly monitor your trades, making it perfect for people who want to trade part-time or with less stress. Swing trading relies heavily on technical analysis, using chart patterns, trends, and support or resistance zones to make informed decisions and increase your odds of success. You can plan your trades in advance, set alerts, and let the market do the heavy lifting while you focus on other things in your life. It's a great way to grow a small account steadily, with less stress and more flexibility, making it accessible for anyone, even if you have a full-time job or a busy family life. Remember, patience and risk management are absolutely key to long-term success in swing trading. Never risk more than you can afford to lose. Now, let's move on and talk about a strategy designed for steady, long-term growth and building wealth over time. The third strategy is dollar cost averaging, or DCA, the ultimate set-and-forget method for building wealth over time, especially if you want to avoid the stress of market timing. With DCA, you invest a fixed amount into an asset like an S&P 500 ETF at regular intervals, whether the market is up or down, rain or shine. When prices are low, your money buys more shares, letting you take advantage of market dips without any guesswork. When prices are high, you automatically buy fewer shares, protecting yourself from overpaying. Over time, this approach lowers your average cost per share and helps smooth out the wild swings of market volatility, making your investment journey less stressful. DCA is perfect for beginners, or anyone with a smaller account balance. No need to be an expert or have a huge sum to start. You don't need to time the market or wait to save up a big lump sum. Just automate your investments. $25, $50, or even $100 a week can add up surprisingly fast, especially when you stick with it consistently. Compounding does the heavy lifting for you, multiplying your returns as your investments grow and earn more over time. Small, regular contributions can turn into real wealth over the years, thanks to the power of consistency and patience. Use DCA as the foundation for your portfolio, making it your main strategy for long-term growth. Then, allocate a smaller portion to more active strategies, like swing or breakout trading if you want to try capturing bigger short-term gains. This way, you benefit from steady, reliable growth while still having the chance to boost your returns with higher-risk moves. Let's wrap up with your next steps, so you can start building your wealth, one steady investment at a time. There you have it. Breakout trading, swing trading, and dollar cost averaging to grow your small account. Remember, this isn't financial advice. Always do your own research and manage your risk. Which strategy fits your style? Let me know in the comments below. I read every comment and love hearing your experiences. If you found value here, smash that like button and subscribe for more. We're just getting started. So much more to come. Until next time, trade smart and protect your capital.